Hello, my name is Richard Claywell. This is another episode of Litigation Speaks. Today I want to talk to you about how do you read and understand a balance sheet. A lot of attorneys don't understand this, and we're going to do this in phases for different types of financial information that you can get. So we're going to talk today again about the balance sheet. What does it do? The balance sheet is a set of financial statements that shows you assets and liabilities at a specific point in time. So if you put it out for December 31st of a year, it may or may not be good, 30 days from now, because there's going to be a lot of changes going on with that. So you need to understand that it is a point in time. It doesn't extend beyond that particular day. This information is valuable for attorneys so they can understand what's happening with the company. If we dissect the balance sheet, what we're going to find is that there are different sections of the balance sheet. One of those sections is going to be called assets. Within those assets, you're going to have current assets. Those current assets are assets that will be utilized by the company within the next 12 months. So in theory, what you have today, a year from now, won't be there. They'll be replaced with something different. We also have non-current assets, and we have fixed assets. Fixed assets is typically the equipment that you're going to purchase, that you need to operate the company with. So those are going to be fairly consistent. There need to be repairs to them. You're going to replace for technology and that sort of thing. There's a section called non-current assets. These are assets that are not going to be utilized within the next 12 months, a year. They're not fixed assets like our equipment that we have, but they're a mixture or something halfway between both of those. And within that group, you might find intangible assets, patents, copyrights, and those sorts of things. If you have cash, let's say for $500,000, and you have inventory for say $1 million, then your total assets would be $1.5 million, if that's all you had on the balance sheet. We want to take a look at the other section that's out there, liabilities. The liabilities are the obligation that the company has. Now, a lot of times what you're going to see is current portion of long-term debt, the notes that you have that are out there. That's going to be the current liabilities. You're going to have accounts payables that would be out there. These are the liabilities that will be due and payable within the next 12 months. So these are items that are out there on the balance sheet. We also have long-term liabilities. The long-term liabilities are going to be the debt, typically loans, that extends beyond a 12-month time period of 1 year. They're not current, they're not due within a year, they're going to be a longer term. So typically we have that. One of the problems that we have when we get financial statements, and I tell my staff this all the time, that not all CPAs are created equal. And it was kind of interesting because I made that comment in an arbitration a couple of months ago, and the attorney that had me on cross said, yeah, well, not all attorneys are created equal either. So we got a chuckle out of that. When the CPA prepares the financial statements for you, a lot of times what they will do is they will show all of the debt as long-term debt. They do not break out the current portion. They should break out the current portion. That's the way the financials are supposed to be presented. So that poses a semi-problem, because what we need to do is look at the ratios that are out there for these particular companies, and we need that current portion of that debt. So the option is, do you want to go back to your CPA and have them get that information for us? A lot of times they're tied up doing tax returns or write-up work, bookkeeping type of work, and they don't have time to do it. So we get to do that. It's going to cost them more money for us to do it than have the CPA to do it. So the CPA just needs to do their job and get it right the first time around. Then we have an equity section, and parts of this are very confusing for attorneys. The equity section is how much money did I put in. If it's a corporation, we have capital stock. If it's a partnership, we have the member investment. We may have additional paid-in capital if it's a corporation. So this gives us some idea of what the funds are that we actually started the company with. Then we have this problem account that's called retained earnings. I don't know where this comes from, but time and time again, when I've talked with attorneys, they think that retained earnings is cash, and it's not cash. Cash is on the balance sheet. Typically, it's the very first item on the balance sheet. Retained earnings is an accumulation of the profits of the company from the date of inception. So there are going to be years where you have a profit. There may be years where you have a loss. The profits may be large or small. The losses may be large or small. But it's an accumulation of those profits that you've had. It has absolutely nothing to do with cash. So if you're one of the attorneys that have been convinced or been advised or whatever, that retained earnings is the same thing as cash, it's not. So when you're trying to make some sort of a settlement based upon retained earnings, that's just flat wrong. So try not to do that. So let's link the balance sheet to business valuation models. One of the things we want to do in a business valuation is to assess the risk of a particular company. We want to look at the balance sheet. We need to know what those classifications are because we will benchmark the data, i.e. we will compare it to other companies in the industry. How are you performing compared to them? So given the right classifications, getting the assets and liabilities where they belong, now we can go out and look at a series of different ratios and tell you what the actual performance is of the company. And typically you will see that in a business valuation report, so you have some idea of what's going on with this. When you're involved in litigation, you will eventually come across the problem of having to have not a fair market value report, but you'll need to have a, quote, fair value report. The fair value report is typically statutory by each individual state that's out there. But the American Institute of CPAs has also a term called fair value. Now, the statutory fair value in the AICPA is called ASC, Accounting Standards Code, number 820. Those two items have absolutely nothing to do with each other. And probably 3 times within the last year and a half, what I've seen is where we have cases where people just don't play well with each other anymore and they want to have a business divorce. The CPA on the other side will go out and they will talk about that they're going to do fair value. Because somewhere along the line they've heard that you're supposed to use fair value for these dissenting rights types of cases. Where does fair value come from? Well, it comes from the AICPA, ASC 820. That has absolutely nothing to do with statutory fair value. And I've got a case we're just now wrapping up. It's the same song, second verse. This guy is citing ASC 820. Now he goes through and explains what that is very, very briefly. But then what they do is they go back to the standards that relate to fair market value, and then they do the fair market value procedures. But they've said in the report they're going to not do fair market value procedures, then they do fair market value procedures. So if you're in a litigation case and you see where the expert has cited ASC 820, fair value, it's going to be wrong. Just no other way around saying it. It's just flat going to be wrong. Within the balance sheet, if we take the current assets that we have minus the current liabilities, and it's important to get those classifications right because we're going to benchmark this to other companies in the industry. So the current portion of that long-term debt, if we don't put it up at current liabilities, we're going to get a wrong answer. We want to take the current assets minus the current liabilities, and that will give us a ratio. And the accounting literature says if it's 2.1, you're doing good. That depends on what's happening in the industry. So we want to take a look at those types of ratios that are out there. We can also detect whether or not we have slow or fast-moving inventory. If we have slow-moving inventory, do we have assets that we can't sell? So we want to take a look at those types of things. So the balance sheet is not just a collection of numbers. It really gives us a lot of valuable information, and there's a whole lot more information that's out there than what I'm talking about today. I want to take a look at that and try to understand it. If you don't have a firm understanding of the balance sheet, there's going to be other statements I'll be talking about. You need to talk to your expert or give me a call or send me an email. I'll be more than glad to talk to you for a little bit about what's going on with these. I want to thank you for listening to this particular podcast today. Check the links below for more information and comment below and give us any feedback that you might have on this particular podcast. If you have an opportunity, go out and look at the other podcasts and give us some comments on that. If there's some specific information you would like for me to discuss related to business valuations or lost profits or forensics, send me an email. Appreciate your time. Thank you very much.